Welcome to this presentation on Central Counterparty Clearing and the EU's active account requirement. My name is Jean-Jacques Van Helten, and I'm a fellow at the Robert Schuman Center at the European University Institute in Florence. Prior to coming to the EUI, I spent some 30 plus years in investment banking in Australia, Hong Kong, Europe, and the UK. I'll now pass over to my fellow presenter, Nick Linder.
Thanks, Jean-Jacques. So my name's Nicholas Linder. My background is in the capital markets as well, including roles in trading risk management, securitization, and most recently in central clearing. And I've worked in Toronto, London, New York, and now Sydney, where I've been at the Australian Securities Exchange on the central clearing side.
Thanks, Nick. So, by way of introduction, since Brexit, the EU authorities, supervisory authorities, have had less regulatory oversight over euro-related derivatives clearing in London, particularly at those central counterparties, which we will refer to as CCPs hereafter, viewed to be systemically important to the financial ecosystem in Europe. Now, this lack of regulatory oversight is considered a stumbling block in the EU's overall drive to build a common capital market under the CMU initiative, and it also resonates with concerns of declining competitiveness and slower economic growth raised most recently in the Draghi report. Now, in December 2024, EMIR 3 came into force for requiring certain financial counterparties and non-financial counterparties to maintain an account with one of the highly dispersed EU CCPs known as an active account requirement. EMIR 3 is the response to concerns raised by the EU Commission and by some EU member states that despite Brexit, EU counterparties continue to clear the bulk of their trades via the London-based clearinghouses. In this two-part presentation, Nick and I will consider the active account requirement known as AAR, and we will use that acronym throughout, and its impact on EU clearing, on the CMU, and the EU's financial architecture. Now, what is a CCP? Before we consider these issues, we need to be clear about what it is and what it does. Basically, a CCP is a legal entity that stands between financial counterparties in any submitted trade in either physical securities or in derivatives contracts. CCPs at a fairly high level can then ensure timely settlement should one of the clearing members default or fail to perform under the terms of the trade or contract. CCPs can reduce systemic risk and enhance financial market stability. Central clearing, then, is seen as critical in supporting business as usual by mitigating credit risk for the market participants. It also is seen to be reducing contagion risks in a cleared market and enhance liquidity. I'll now pass on to Nick, who's going to take a much more deep dive and work through some of the examples and activities that we've seen with CCPs of late. Nick.
Thanks, Jean-Jacques. So we have a new slide up that gives us a schematic attempting to differentiate between non-cleared and cleared markets and how they operate. So we have on the left-hand side what we call the bilateral market, or if you like, individual transactions directly between market participants. And on the right-hand side, we have a schematic representing what that same market would look like if it were centrally cleared. Before I go through the individual components of each of those two schematics, I just want to make a couple of comments about the types of markets that we're talking about here, because which type of market we're describing can have a fairly significant impact on how central counterparties end up performing and their objectives, policies, and procedures. So really, I just want to differentiate, first of all, between securities markets, cash markets, and derivatives markets. The reason being that with securities markets, obviously, there's a physical settlement that needs to occur as well as cash. Whereas on the derivative side, we're just talking about cash settlements that support underlying contracts. And to the extent that physical settlement forms part of the guarantee under central clearing, it needs to be considered as well as the cash implications if we get into a default scenario by a clearing member. I also want to just mention the distinction between listed and unlisted markets. To the extent that we have either a cash securities market or a derivatives market that's listed, that brings us a level of fungibility between the securities and contracts that are on offer. In particular, for derivatives, that would be futures or futures options, and for cash securities, obviously, equities or bonds. Whereas on the OTC side, the unlisted side, we're really talking about structured derivatives, and the ones we'll be focused on mostly today will be the interest rate swap market. So I just want to bear in mind the distinction between those types of markets and how that'll come into play as we go through the details of the clearing mechanism. I also want to make a couple of comments about the entities that play a role in this conversation. Obviously, we have the CCP that Jean-Jacques introduced. We have this concept of clearing members. They would be the direct clearing members, sometimes they're known as, or the entities, either banks or sometimes non-bank financials that deal directly with the clearinghouse. However, we also have to consider that in the background are their clients, the clearing members' clients. They will form a pretty central role in terms of how the AAR is seen as possibly panning out. So you have to bear in mind that behind the clearing members themselves, there will be a host of sometimes very, very large clients, pension funds, so forth, and some of them will be captured potentially by the AAR. If we go back to the diagram, really we're talking in this case, this is schematic represents a physical securities market. So here we see, for example, on the individual transaction side, on the left-hand side, counterparty A and counterparty B, have a transaction involving a certain number of units, 15 units of a given security S, in exchange for a certain number of euros, 150 euros. The proposition under central clearing then is simply one where we replace those bilateral transactions with a set of transactions only between each clearing member, A, B, C, or D, and the CCP. So this replacement of transaction sets from the left-hand side to the right-hand side is sometimes referred to as the effect of a multilateral net down. So if you add up all of the cash flows and all of the securities flows on the left-hand side, you come up with the same aggregates that you see on the right-hand side. The benefit then is that you only, as a clearing member, you only face one settlement against the clearinghouse, and the clearinghouse will take care of all the other counterparties for you. So whereas previously you might have had transactions with any number of other individual counterparties, once you centrally clear, you only deal with the clearinghouse. And you'll notice that all of the clearinghouse transactions will net down to zero at the end of the day. So the CCP will actually end up with a net position at the end of the day. And you'll see that we've craftily used the word positions at the top of the right-hand side. And we'll come to that when we start discussing default management. But effectively, if you look at the counterparty A that's been circled, if counterparty A, if a clearing member fails to perform on the day, the nature of the clearing guarantee is such that the CCP then inherits those commitments under that trade, and will be forced to continue to settle with the remaining non-defaulting clearing members B, C, and D. So those open transactions, if you like, unsettled transactions, in the case of a defaulting clearing member, become the positions that require closeout by the central counterparty. Just a couple of words around some of the terms that are used in a default scenario like that. The CCP will carry default resources, default fund and default management resources, financial resources and operational resources to handle such a default scenario. The most common one I think that everybody would be familiar with would be margin. Clearing members are required to post margin to the clearinghouse, depending upon the size and number of transactions that they are submitting for clearing. Behind the margin then will be a commingled fund, the default fund, sitting as another resource that the CCP can bring to bear. The default fund will carry commitments by the clearing members themselves that will be commingled, as well as commitments from the clearinghouse, sometimes known as the skin in the game from the clearinghouse. And the way we're going to do this is by trying to go through two different default events, historical default events. They're quite contrasting. Certainly, I think everybody would have heard of case number 2, which is the Lehman Brothers default event in 2008. The case 1 that we're going to start with is a smaller default event. It's specific to the Nordic commodities futures markets. The clearinghouse, the CCP in question, was NASDAQ Clearing AB. The clearing member that defaulted was an individual trader, but it wasn't just any individual trader. This is Norway's richest person for quite some time. And the product class that they're in question that was being cleared were listed electricities futures. So for listed electricities futures, the market standard default management procedure is usually to close out the positions. We have a set of contracts that are fungible. So if you have a long position that you've inherited as a clearinghouse, really all you need to do is to enter into an offsetting short position, and that's pretty much the end of the story. However, we're just going to make a note here that what actually happened in the case of the NASDAQ clearing default event is that they elected to go to an auction, and an auction is the market standard for usually just OTC derivatives, and the reason being that OTC derivatives tend not to be fungible to the same extent as listed derivatives, and therefore offsets are not quite so easy to come by. So a hedged and auction technique is usually put in place, where the CCP will bring in a non-defaulting clearing member, hedge out as much of the risk as they can in the OTC portfolio, and then auction it off to the remaining clearing members. And that's the procedure that NASDAQ Clearing went with here, even though the product class that was at issue with the default was actually a portfolio of electricity futures. It's just something to note. We'll get into a bit more detail on what we think that means. We're just going to contrast that with what happened on the LCH side. So LCH is London Clearinghouse. The clearing member was Lehman Brothers. They have a particular unit that they use as a clearing member, Lehman Brothers Special Financing Incorporated. The market is for OTC derivatives that are cleared. There's a very specific electronic market at the time that served that market, OTC DerivNet, and the product class was fairly vanilla OTC interest rate swaps, although the portfolio was obviously quite large. We'll get into that as well. And again, because of the OTC nature of the portfolio, the default management procedure that LCH elected to use was to hedge and then portfolio auction out to the non-defaulting members. So I'm going to run through each of the two timelines. This first slide is the LCH 2008 default event timeline. And we're going to run from left to right. We've got a start date. And the very first event above the timeline at the start date is an announcement by Lehman's of their bankruptcy filing, not in the same jurisdiction as LCH, but in New York. So that then led the very next business day, CCPs began to announce default or suspension of Lehman Brothers, and they kicked off their default management process. So I've listed some of the CCPs that were at issue. That's important to note because we were talking about a global investment bank, although the bulk of their OTC interest rate swap book was cleared at LCH. They had exposures to other clearinghouses in other markets. And so the same process was kicking off at other CCPs globally. The other thing to comment about +2 business days forward and the LCH announcement on the commencement of client account transfers is that we mentioned earlier that, while you have direct clearing members dealing with the CCP directly, it's often the clients that sit behind them and their portfolios that where a lot of the risk will sit. So it's an important event when the client accounts that sit behind Lehman's, in this case, the defaulting clearing member, can be ported or transferred to other non-defaulting clearing members. That's a systemic, or a reduction in the potential for systemic risk. We're containing the risk, if you like, within the CCP, and we're not exposing the clients of the defaulting clearing member to the default event directly if we can get them over to another non-defaulting clearing member. And I just want to contrast that Lehman Brothers timeline very briefly with the NASDAQ clearing event, default event timeline. So we have a start date. NASDAQ clearing announced the clearing member is in default. That's a little different from what happened with Lehman Brothers, where the original default event was actually a Lehman Brothers filing in court in the States, whereas with a single trader clearing at a single CCP, really we have a default event that's restricted to the clearinghouse itself. We also get a slightly different sequence of events. The first thing that we see after 3 business days or 3 calendar days is an announcement from NASDAQ that it's going to adjust its models and demand bigger capital buffers in order to shift more of the risk from the mutualized default fund, which is funded by the non-clearing members, to the owners of individual portfolios. Now, this really is a signal that perhaps the closeout procedure isn't going as well as they thought it might, or isn't perhaps going according to plan. The first announcement is really one that says, in fact, the non-defaulting members, they're going to have to own now more of the risk in their cleared portfolios by posting higher margin. The second event post-default then is another 4 calendar days pass, and we get an announcement that all the losses associated with the defaulting portfolio closeout have been fully, to the extent that they've been covered by the default fund, have been replenished. And the term they use are contingency funds. In other words, funds that perhaps they didn't expect to lose further down the waterfall. And we'll get into exactly what constitutes a contingency fund, or where it sits in the fall fund. And then the next day, we get non-defaulting clearing members independently reporting that losses have been occurred, although they've not been directly reported by NASDAQ in terms of sizing. And a restricted auction was held on the default portfolio. So this process was much more opaque than the Lehman Brothers process. With Lehman Brothers, we had many CCPs all making announcements as soon as the events were really underway or completed. Whereas with the NASDAQ clearing event, with the single trader default, we've obviously got some unexpected losses. We've got only one CCP involved, and they've chosen a sort of non-market standard default auction to try to close out futures positions that theoretically they should have been able to close out simply by entering to offsetting trades. On this slide, we're going to sort of reveal some of the losses. But before we do that, I just want to start by making the point that when we talk about the LCH Lehman Brothers default event, the total losses that we know about came to just about a third of Lehman's total margin posted with the clearinghouse. Now, generally speaking, that was viewed as a pretty good result. The default fund did not need to get tapped at all, and LCH were able to close out the bulk of the risk, we know, within about 5 business days. So that's sort of our benchmark for the 2008 event. If we dial forward 10 years then to the NASDAQ clearing event, we can then look and see, okay, well, what happened to the initial margin that INRS posted with the clearinghouse? So if we can start to reveal some of the components, we see there then that there's the initial margin. Again, INRS is the individual trader initial margin. The individual traders and clearing members are also required to post default fund contributions. we can see then that the clearing member collateral, their initial margin and their default fund contribution, we know that that was completely exhausted, but the exact amount is not reported, and this is part of the issue we have with the default events. Is we don't always get necessarily full disclosure, public disclosure. There might be full regulatory disclosure, but we don't always get full public disclosure on things like the amount of initial margin that a clearing member posts. And there are often good competitive reasons for doing that. But we're sometimes working with limited information in terms of understanding how losses are incurred and what the magnitudes are. So then if we move on to the next set of financial resources available, well, NASDAQ clearing itself posts contributions into the default fund. So this is the skin in the game contribution that I mentioned earlier. In this case, that's a public number, 7 million euros. That was exhausted. And then we carry on from there to the wider default fund. So this is the commodity service default fund. So NASDAQ is a large business. The commodity service, their NASDAQ clearing AB business, is just one of those businesses. It has its own default fund. The funding for the default fund comes from all of the clearing members, not just the defaulter. And that came to 107 million utilization out of a 166 million euro total fund size. So this is where the losses stopped, if you like. We had a commodity service default fund totaling 166 million euros, of which 107 was utilized to close out in the default auction the defaulter's portfolio. So we know we have 107 of the default fund, 7 million from the NASDAQ capital contribution, and an unknown amount from the defaulter's collateral initial margin and their default fund contribution. And then if we go on to the remainder of the financial resources that would be available, it would be NASDAQ's general capital fund. So this would cover their other businesses as well, and the general default fund. NASDAQ's own capital, if you like, as well as the general default fund that NASDAQ would have available through all of its clearing activities, unused. So in some sense, it's not a disaster. The clearinghouse was able to continue on. It was able to replenish the commodity service default fund by tapping its clearing members for further funds. But I think it raises the question of how, particularly an individual trader, was able to run such a large open position in listed futures that are fungible with other contracts of the same type. They weren't able to close it out. So there's something about the size of the open position and the lack of enough initial margin posted by the defaulter to cover the closeout. That's what we can see on this slide. I'm just going to jump away from that contrast for a little bit, and I'm going to talk about a wider comparison of how adequate default funds are post Lehman's. So we know that the NASDAQ event occurred 2018. We know also that in 2012, BIS implemented the principles for financial market infrastructure governing CCPs, best practices for CCPs, so PFMI as it's called. And so since 2012, we have a pretty good idea how regulated CCPs are operating in terms of their default management procedures, their default fund contribution setups, and their initial margin requirements. So prior to the NASDAQ event, we look at some 2016 figures. We've got 4 years under our belt of PFMI standards for things like initial margin and default fund contributions. What can we say about the adequacy of those cover levels across the major interest rate swap clearinghouses against the exposures that they face? So the top half of the table are the resources, the default fund resources. Now, these resources sit on top of the initial margin that's available. And on the bottom half of the table is the calculated risk that those default funds are really there to capture. And we call those stress losses. So these are calculated losses under extreme but plausible scenarios endorsed by each relevant regulator that really stress all of the clearing members' portfolios at each clearinghouse, and we size the default fund resources in the top half of the table against those exposures that we see by stressing the valuations on the defaulters, or sorry, on the clearing members' portfolios. I've listed 3 clearinghouses. These represent the bulk of the OTC interest rate swap clearing globally at the time, and to some extent still today. LCH Swap Clear Service captures probably over 90% of the market. We did at the time, 2016, the time these figures were reported, and it does today. CME, the Chicago Mercantile Exchange, they also offer an interest rate swap clearing service that captures some of the market. And at the time, the Japan Securities Clearing Corporation, they also offered an interest rate swap clearing service that captures a relatively small share of the market. And what I would point out from this table is that if you compare the total default fund resources available at each of the clearinghouses, if you compare them to the largest 2 clearing members default. So this is the stress loss if the largest 2 clearing members default. I mean, basically, it's saying we've got adequate levels of coverage under PFMI compliant methodologies. So that's sort of saying that by and large, if you do this correctly in terms of margining and stress testing and default fund sizing, and you monitor these exposures ongoing, so you don't just monitor them for 2016. These are based on publicly available filings by all the clearinghouses. You should get some comfort into, or at least a warning sign, say perhaps in the case of JSCC, if you see that your total default fund is not as much as the stress loss from your 2 largest clearing members. So that's a tick for LCH, and that's kind of what we saw with the Lehman Brothers default as well. Their resources were adequately sized for the default event, and the results sort of spoke for themselves in terms of the realized losses. They only really needed the initial margin from the defaulter.
Thank you very much, Nick, for that very, very informative and contrasting set of examples between what happened with NASDAQ versus LCH. Now, we just sort of tried to summarize around the recent regulatory developments in the EU. So let's just think about until 2020, when the UK formally left the European Union, the bulk of CCP clearing that Nick has elucidated in quite some detail for OTC derivatives for the EU actually took place in London. So to deal with Brexit, in September 2020, the European Commission adopted what it interestingly called a temporary equivalence decision on the UK framework on regulation for CCPs. And as we heard from Nick, there is quite a bit of involvement and requirements for oversight of clearing activities that would, since 2020, been taking place outside the EU. And based on that decision in 2020, ESMA then recognized 3 UK CCPs as so-called third-party equivalent and acceptable from a regulatory point of view. These 2 CCPs were seen to be systemically important, Tier 2 CCPs as it's technically called, which were not surprisingly LCH, given what Nick has already outlined, and IceClear Europe. Subsequently, in 2021, ESMA noted that 3 of the clearing services that they were undertaking were of very substantial systemic importance for the European Union's financial stability, and in addition would pose risks that may not be fully mitigated under the current regulatory framework. In December 23, then, this is how this process develops, the EU finalized amendments to its regulations around clearing through EMIR, requiring that banks subject to EU oversight undertake at least some of their clearing in EU-denominated or Euro-denominated OTC IRS in the European Union itself under the so-called active account requirement. Now, this is a very significant step because, in a sense, what it meant was that, as we will see in more detail, that the European Union required and indeed insisted on at least some of the clearing activities taking place within the EU itself. We will deal with that in more detail in part 2 of our presentation. Thank you very much for your interest so far. Stay tuned for part 2 of our discussion. Thank you very much.